Let's hit you with another one of our trades that we threw out this week. This one is going to be for Costco. So one of the plans that we had involved, we have a couple people that are talking about, it's going to be staying in pattern. Just wait for the break. Just wait for the break. And then there's a crowd that says they want to get in early. They want to play for the upside. Or no. This is going to crash to the downside. Look at the convergence. It's going to come back down. So my thought process was, how can I appeal to both of those crowds and develop this trade, and that can work for all parties involved. They can keep that exposure to whichever direction that they want, but also play to those people that say, wait for that pattern break, wait for that pattern break. So if you don't know the structure of this, what I'm suggesting, what I'm calling out, is going to be a call condor. So I'm taking an upside bias. Now, if you took a downside bias, you're going to be putting on a put calendar, and that's what you're going to be considering here. So if you haven't run a call calendar before, what you're going to be doing is the front month, the one that's going to be whatever expiration you choose, the front month. All right, that is going to be what you're going to be selling here. All right, so. And the reason, we'll go into details on why when I'm going to do that. We're going to be selling a call that is going to be near at the money or slightly out of the money, for the slight reason we don't want it to get hit. All right, so we either think that it's going to come back down off this trend line, or that it's going to break out, or maybe not pull back a little, but it's definitely not going to go past our strike, and we're going to collect that full premium that's on there. But what we're also going to do is we're going to be looking about 30 DTUs, days till expiration ahead, and we're going to be also buying that same expiration, or excuse me, the same strike that we picked for our front month, which is called the back month. All right, so for example, let's say we have an upside bias. All right, we are going to be selling this week, which is going to be June 25th. We're going to be selling the let's do 390. All right, 390, and you're going to be collecting about $120 off of that if it doesn't break to 390 this week. All right, so that's $120 in your pocket if it doesn't break to this week. But we are going to say we are going to keep our bullish bias towards this. We still think there could be upside at any moment in time. So we're also going to look to the July contracts, right? We're going to pick up the July contracts at the 390 as well. So not too far out. The further you go out, the more time you're giving to you, but you're just trying to find ways to discount it because you think that it's going to take a little bit of time to get there. So you might as well collect a little bit while you can. So that leaves you with a 390 in July. That leaves you short a 390 right now. So what you want to happen in this case, all right? So by the end of the week, under 390, you collect that full amount, and then you're going to have that discounted price on your 390 July position. Now you hope that it doesn't move, and so that way Ivy isn't affecting it too much, the premium isn't falling down too much as well. You're also just buying time for yourself that maybe next week is the actual breakout to the upside. All right, but we'll get more into detail on the how you want to handle that and manage that moving forward. But if you were the other way around, all right, and you are the bearish side of this, it's going to collapse, it's going to go down. You're going to take that slightly out the money, near at the money, selling the put because it could still be playing the pattern here, and then buying the longer dated put because you expect the downside. So just reversing the logic in how you took the upside on here. So what you want to do. All right, so as you collect that week, and then now you're on to next week for our play, right? Our call calendar that we have. We can then look to either, if it still hasn't broken out, it's still playing that super tight range of that pattern. We're going to look to the exact same call again the following week, which would be what, July? July. So we're going to be selling that 390 the next week, or let's say it's breaking out, but it's breaking out really slow and you just hate this, all right? So maybe you can turn to, I want to ride that 390 on the July side, but I could also sell a 395 call that maybe, since this is slowly breaking out, I can collect a little bit more. So when we're buying that July position for about 470, not only are we getting the 120 back on that to make it about 350 that we're actually risking taking on that upside bias, but then hopefully whatever we can collect from the next week and the next week and the next week and the following weeks after that, hopefully we can get to a near free position, or we're just buying time for that breakout. So the logical thing to ask yourself too when it comes to this is, when the breakout does actually happen, whether it be to the downside or upside, how do you manage that? How do you look towards this play and say, well, I don't want to be caught in this because if it breaks out, I'd lose money on this? So you need to kind of just take it on the chin. You can evolve this into so many different ways to do this, but let's just keep it simple. Take it on the chin. Let's say, you're down $50 on the call side for this week as it breaks out tomorrow. All right, so you're $50 less that you made, but you have a 294 or excuse me, 394 break even on that. So if this truly does break out after consolidating for a month and you get that, 395, you get to that 400, who's going to care? You risk, you put up $50 for that protection that it could still play the pattern. So it's kind of, just think of like an insurance policy essentially, all right? Just in case it happens, you have that there. But since it's not going to happen, you can slowly take that off and now officially ride your play that you had from the beginning, that bullish or bearish bias to the upside. Now, just take that down to the bearish side, all right, if that's how you're going to do this. And that's what you want to be doing on these plays, these consolidation plays that haven't broken out yet. You don't need to wait for a break. You can play to those sides by taking the back month, longer dated positions, and using the front month or front week, however tight you want to play this, by selling within the pattern. All right, so there's so many different ways you can play. There's never an excuse not to play. Cash is trash. That's the motto. You can always find something. Be smart, be creative, and try to find ways to pull their money out of the market the best way that you can.